Stochastic indicator secret strategy. In this video, I'll walk you through this very indicator. The first thing here is how does it work, and the next thing is big mistake that people make when using the stochastic indicator, and you need to avoid this mistake. The third thing is stochastic indicator based setting. If you're using the default setting right now, then you will be using the wrong parameter. I will show you the right parameter to use so that you can optimize your stochastic to work in your favor. And the fourth thing is the right way to use the stochastic indicator. And the fifth thing is stochastic trading strategy. All of this in this very video. So pay attention and watch the video all the way to the very end. The first thing we have to ask ourselves is, what is stochastic indicator? The stochastic indicator measures momentum of price of a financial asset, identifying overbought or oversold conditions. So this is what the stochastic does on our price chart. So practically what that means is, let's say for example, market was coming all the way to the downside, impulsive move, retracement, impulse, retracement, and the market move, impulse. What the stochastic does is it tells you the force from here to this very area and signal you that the market have overbought or have oversold. So therefore the force that the market was using to move from here to this very point is reducing, and there is potential retracement or reversal in the market. The same thing happens when the market is moving upward. Market move, impulse, retracement, impulse, retracement, impulse. The stochastic indicator helps us to determine if this very point is the last point the market is going to pause and begin to come all the way back to the downside as well. Either of this situation apply to the stochastic. So how does the stochastic work? First of all, before we talk about how does it work, how do you put it on your indicator? So to put it on your indicator, you go to the indicator section right here, and if you come right here, you will see two kinds of stochastic. We have the ordinary stochastic indicator, and we have the stochastic momentum index, and we have the stochastic RSI. These two are combination of two indicators. So for me, I prefer using the stochastic RSI. That is a combination of the relative strength index and the stochastic. I don't use the stochastic alone. You can use the stochastic alone, but I prefer using the stochastic RSI. So I'll put it on my chart, and as I put it on my chart, it is covered that it is now right here. Okay, so this is the stochastic indicator on the chart right now, and it is the RSI. So how does this stochastic indicator work? Basically, you see the market right here move from this very point downward. So this very point, if you look at this very indicator from here, is the overbought condition. That is from this very line, this dotted line right here. This is the 80% line upward, is the overbought condition. What that means is if market move upward and this line, these two line right, that is the blue line and the orange line, come into this very area, as you can see at this very point, it means that it is overbought. The market has overbuy. That means there will be a potential drop all the way to the downside. And the next thing here is, if you look at this very point as well, this very dot right here, it is covered. This is the 20% line, and the 20% line below is the oversold condition. So if the market has moved all the way to the downside into this oversold condition, it means that the market now have high chance of moving upward according to this very indicator. Now, if you use this indicator like this with default setting, then you might not be getting the real approach to using stochastic the right way. Big mistake to avoid when using the stochastic. We know that the stochastic was designed to measure overbought, oversold condition in the market, but the way you should use it is different from what the stochastic is telling you. Let's say for example, normally if market enter into overbought right here, you're supposed to sell from this area, for market to come back down, and if you did, you should be stop out of the market, and the market come up again, enter into overbought, and if you sell from this very point, you should be stop out because market continue upward. If you take stochastic and if you trade stochastic this way, you should be making a big mistake using this indicator. So don't trade stochastic by trading overbought and oversold condition. If you take it that way, then you should be making big mistake. Avoid trading overbought and oversold condition anytime the stochastic enter into overbought and oversold condition, especially using the default setting. And the next thing we have to talk about here is the stochastic indicator based setting. I think that is what a lot of you want to hear in this very video, and it is very simple. If you use the default setting, then you are making a very big mistake using the stochastic. So the best setting I use, and this is my personal opinion, you can have something contrary to this, is you have to go to the setting right here and change this very key to 5. Okay, this is the best setting I use. It helps filter out false signal. If you look at it, it smoothens the indicator and allow you to take a high probability trade. In fact, this will filter a lot of trades for you, but it's going to show you the most accurate right trade to take. So instead of you using the default setting for the stochastic, use this very setting, okay, by simply coming to this very section and click on the edit button and then come here to input and change the key to 5 and click OK. Once you are done with that, then you can use this very setting. The right way to use the stochastic indicator, if you come right here on the chart, for you to use the stochastic indicator the right way, you have to define your trend. Let's say, for example, market is moving upward, market move impulsive, move retracement, move impulse, retracement, move impulse, retracement, and another impulse. For you to use the stochastic together with this, you must define your trend. And if we conclude that this is an uptrend, which is very, very correct, and we want to take a trade only when the stochastic enter into oversold condition. So market is moving upward, so we want to take a trade at oversold condition, not overbought. Okay, and even though market enter into overbought, we're not going to take a sell position. We are focusing on the trend. So if market is moving upward, we should focus on buying the market only from this very area when the stochastic enter into oversold condition. The same thing apply to when the market is coming back down. Market move impulse, retracement, impulse, retracement, impulse, retracement, impulse. This is a downtrending market. It is very clear. So we want to use the stochastic only when it is at overbought condition for a sell position. So we want to sell from here, we want to sell from here, we want to sell from here when the stochastic enter into the overbought condition, and avoid buying the market from this very point, from this very point, and from this very point, because the market is in a downtrend. This is the right way to use the stochastic. You trade in line with the trend and don't counter trend trade at all, because the stochastic indicator is a momentum indicator. We want to trade in the direction of the prevailing momentum in the market. Now that we know how it works, mistake to avoid, the best setting, how to use the right way, what is the strategy that we can apply right now on our chart when using the stochastic? First thing, you have to put the stochastic on your chart clearly, and I am on the 4-hour chart usdjpy. So if you look at this very chart, it is called that market is moving upward. First thing, you must define your trend. Market move upward, retrace, move up, retrace, and then move upward. We want to take a position only when the stochastic enter into oversold condition. That is this very point right here. Okay, only when it enter into oversold condition as market is moving upward, that is only when we want to take a position. And you take a position when the market close above the last bearish candle. Let's say, for example, in this case, market enter into oversold condition with this on the indicator, and then we want to take a trade when this very price action move upward and close above this very bearish candle right here, because this was the last bearish candle on the price action. So if you do that, this is how you should take this very position. I will take a buy right here, and then this is the candle that closed above this very bearish candle right here. So I'll place this here, and then my stop loss should be below this, slightly below this, and then I will look for 1 to 2 risk reward on this very trade, and I can guarantee you that this market is going to move in that very direction. If you take 1 to 2, you should be in profit already, but you can still do 1 to 3 risk reward ratio. And this is very important. We are taking a trade in the direction of the trend. Let's say, for example, this enter here. We are not taking this one because it does not enter into the oversold condition. We are not taking this one as well because as at this time, market was still moving downward. So we're not taking this very one. And of course, this very one, we're not taking it as well. So this is very, very important. You trade in the direction of the prevailing trend when you are using the stochastic. Another set of example that you can find on this very price action is this very market moving all the way to the downside. We see market creating lower lows right here. Market is moving downward. This is an obvious downtrend. So we can take sell position throughout on this very chart. So right here, market move all the way from this very point to the downside and give us a sell opportunity at this very area. So if you look at it, there is a sell opportunity right here. So I will take my short position to right here, and I want to take a position when the stochastic come out of the oversold condition right here, and this very candle have to close below the last bullish candle. In this very case, I am taking a short position or a sell position. So I'll place it right here, and then I will place my stop loss at this very area, slightly above this very area, and look for 1 to 2 risk reward ratio at this very point. Market should go in your favor. Another sell entry is at this very area. Market enter into this very point of overbought condition, and from this very candle, this candle close below this very bullish candle right here. So I'll take the sell position and then I'll put it right here. My stop loss is slightly above this very line of resistance, and look for 1 to 2 risk reward ratio. This is a good trade to take, and then the next position should be at this very point as well. This very area is the next position, because where the market enter into overbought condition and come out, so we have to look for a candle that close, which this candle right here do close below the last bullish candle right at this very point. So we take another short position on this very candle right here, and our stop loss is slightly above this very point of important resistance, and we look for 1 to 2 risk reward ratio, which is very, very simple to do. And the next one appear right at this very point. If you look at this very example, this bullish candle is very huge, but as at that time, market was still moving upward, and the market come back down on this very candle, and this very bearish candle close below the last bullish candle right here. So this is where you need to take your trade. So I'll take my short position or sell position to place it here. My stop loss should be above this very resistance. My stop loss is above this very resistance, and my take profit target is 1 to 2 risk reward ratio, which is very, very possible right there. And then if you look at this, which is the last example on this very note, discover market come into this very point and stay here for a very long time. So this gives us another sell opportunity, and the last bullish candle was this very candle, and this other bearish candle closed below it. So we have to take a trade right here, and then our stop loss have to be slightly above this very level of important resistance, and then we look for 1 to 2 risk reward ratio. If you take stochastic trading like this in this formation, it will make you very profitable. As we know, when using an indicator in the market, you don't use one single indicator, you use it together with other tools or indicators. So therefore, the stochastic indicator should not be used alone, even though with this strategy, it can give you 60 to 75% winning rate. And this is very important. And one of the tools you can use is the Fibonacci retracement to know where retracement end in the market. Consider supporting this channel by leaving a like for this video, subscribe if you have not, and turn on the bell notification for more Forex videos like this one. Also check the channel for other Forex content. Join our Telegram channel, the link in the description of this video and also in the pinned comment. If you want to watch my other video, check this video right here out. It's going to help you, and check this video out as well. It's going to help you. Thanks for your support.